Bill, so we'll see when they pop up and we can go over them. Let's start here. I guess they just came across the wire here. I got 1.7% on the positive for the headline number. Take out transport, 0.6%. Both of which are better than expected and also improvements month over month. Your initial reaction to this with somewhat of a muted reaction in the market, but we do see the Russell turn green.
Right before, really, the dollar was what was getting crushed. Euro was sort of melting higher a bit. We had a little bit of a reversal in the yen coming off the session lows. And better than expected data is likely going to lift the U.S. dollar and sort of reverse some of that. But, the equity markets and commodities have just been kind of doing their own thing this morning, sort of finding, it's end of the month. You're getting some weakness in the equities. You mentioned the Russell, but I think there is some decent support here that we can look at. Now, two things. Today is the first day of a very bullish seasonal pattern in the S&P. 15 out of the last 15 years. This market, the S&P, has been higher and averaged about 75 points. It begins today and lasts through July 23rd. So I think the interesting factor here is, everybody's been talking about it. Managers, wealth managers, portfolio managers have been really underweight the stocks that have been driving this market. It's their time here with a lot of weakness in the NASDAQ yesterday to get some window dressing before the end of the quarter here, because those quarterly statements is really what people are going to look at in a couple weeks from now. So I think that's important to take here. But then with commodities, we've seen crude, copper get really bludgeoned here overnight, but gold and silver perking up a bit. I think the important thing, less on durable goods, but more about what are some of these home price numbers. Got Case-Shiller, got home price index. Also with consumer confidence here this morning too. So I'm looking at those a little more closely here as the morning develops.
Yeah, and those are due in about 30 minutes, some of the housing data, and then, of course, we'll get some of that consumer confidence data in about 90 minutes from now, so we'll keep our eyes on that. But, Bill, you talked about some of that seasonality component. You're not the first that I've heard talking about that recently, so obviously something that a lot are focused on. You have the end of the quarter kind of markup that sometimes we hear calls for as well. From your perspective, it sounded like you see that potentially taking place in some of these, big mega cap tech stocks. Is that going to mean potentially more of the market we've seen recently, maybe take out the last 6 or 7 sessions, but a NASDAQ leading the charge type of a market for at least the next couple weeks?
Yeah, I think that, as we move in through the Fed, and I think it's going to be important that for the NASDAQ to lead, that rates are not accelerating higher. And right now, as we look into that July meeting, we still have a lot of big data. We got a jobs report, non-farm payroll was that next Friday, and then we got a CPI about a week and a half after that, and that leads into the July meeting. And now, a 25 basis point hike is likely becoming fully priced in by then, unless the data really starts to deteriorate. But the Fed, I think the important thing is that they're more hawkish now. Now they're not going to talk about cuts that were initially being priced in a couple months back, but ultimately they're going to sort of push this narrative. You're going to get a couple more hikes, and I don't see that happening. They may get this July one might be the last one, and so we could start to see that narrative dissipate a bit if the data isn't really fully there, and that's what I'm watching for. Because if rates start coming back down a bit, just a slight bit, or they're not accelerating higher, I think, yes, the NASDAQ can lead through this summer. And it's very common to see, the big stocks, and look back at 2021, especially where the market of stocks topped, a totally different environment in February. But then you had the indices really lead. So I think during the summer, I think that's something we could find ourselves in, as we move into August. Now, I'm also seeing some of the commodities here. I think that if we sort of skate out of a recession, I would be interested to see what copper and crude could do, and especially from the overnight. Just kind of switching gears here, the Chinese yuan against the U.S. dollar is very important to watch. That's a CME product, is the Chinese yuan. CNH is the symbol I have it as. And that was just melting higher, meaning the yuan was weakening, the dollar strengthening, a little bit of a reverse course overnight. And that's because the People's Bank of China, they marked the yuan a little stronger. So this could be a little bit of a change now, a shift in policy where they don't want to see the yuan continue to weaken. And if that's the case, that CNH product, the CME, would sell off, meaning that's the yuan strengthening, which it is here today. That would underpin copper and crude oil during the summer. And as we move into July, remember, Saudi Arabia is cutting another 1 million barrels per day. And they're putting their money where their mouth is. So it'd be interesting to see here as we look into next week into July.
Along those lines, kind of final thoughts, though, because I've been looking at crude oil, and we heard so much about this robust Chinese reopening, right? And then it's been kind of a flop, at least in terms of expectations. But it seems that, OPEC and some of these oil producers sniffed that out a long time ago. They've been cutting production for the better part of the last quarter. I said this at the time, I think there's more to these cuts than just trying to, boost oil price here. I think there's real demand concerns. You look at then treasuries becoming more, at least in terms of yields, more correlated to the S&P 500. I see a market, tell me if you see this or maybe disagree, that seems to be more worried about a recession than it is about inflation at this point.
I do agree with that. I think the market is more worried about a recession than inflation. The problem is that the Fed is still pushing that narrative that they are trying to conquer inflation. Until that shifts a bit, the market's not fully going to respond to that. So that's where we are right now. That's sort of what I was alluding to and talking about with that July hike. They cannot talk about a real pause or a real shift in policy until that exact moment that they are ready to do so. You look back at 2019 2018, the S&P was down 17% and they hiked at that moment 25 basis points, and they said they were going to hike 2 more times coming into 2019. They never hiked again. Inflation was a different story then, but we are dissipating inflation now. So I think there's a lot more parallels from 2018 meeting in December then that we're looking at here in July, given the trajectory of inflation as it's coming down. So I think when that finally switches gears and the Fed really sort of echoes a standstill, a real pause that we might hear them echo that could last for a couple of months. I think that's something that's going to be very important for the market, and the market would react off of that. I think we'd start to see yields come down a bit, and that is what could power the NASDAQ and some of those big tech leaders through the summer.
A lot to focus on. We'll see where things go throughout the summer. Some seasonality components about to kick into gear. Looking forward to it. Appreciate the conversation. Bill Baruch, president of Blue Line Futures. Always a pleasure.